Hey everyone, Kris Barney from 3040 Wealth here. Today, we're going to dive into tender offers. So whether you've gone through a tender offer in the past, at your current company, this is the second or third time it's happening, or at a prior company, it's a really exciting time. But there's also a lot to consider, a lot to understand, and more than a handful of key decisions to make. So we've put together this equity compensation playbook to dive into what you want to focus on, the key information you have, and a couple different ways and resources to think about how to make a decision that's best for you. Let's dive in. If you're one of those individuals who likes to jump straight to the answer, in more than 80% of the tender offers that we've evaluated, we end up recommending that the individual participate and sell at the full amount. Mathematically, that obviously means that sub 20% of situations that we've analyzed, we recommend they either only participate in part or not at all. But there's a lot more going on here. The key decisions you need to think about if you're going to participate, how you tax optimize, how you think about all of it in the context of your financial plan and your investment concentration risk. So this playbook should cover all of that and more. Let's dive in. First, the key decisions that you have to make. Primarily, can you participate? And if you can, should you participate? Second, if you're not sure yet whether you want to participate or not, we'll walk through a couple different ways and frameworks with which to help you decide. Third, there's some key information to gather. If you choose to participate, what are the steps that are going to occur? How much information do you need to input and where? What are the tax implications and how to plan around it? And then last, we'll jump into some FAQs, some pitfalls to avoid, and a handful of other resources. Here's the key decisions that we want to be focused on. All right, big question number one, can you even participate in the tender offer? When companies launch a tender offer, there's a number of different eligibility criteria that they have. If you're an existing employee versus a former employee, do you have vested options or not? Are your options ISOs or NSOs? Do you only have RSUs? All of these are going to impact whether or not you can participate. Typically allowed are existing employees with vested options. Case-by-case basis are former employees and or existing investors. And typically individuals that only have RSUs are not able to participate for the ways that RSUs are structured, but that's not always 100% the case. Now, if you are able to participate, your company should be providing you with some critical information. The key components of that are typically, what's the actual transaction price that you should be focused on? A lot of times there are a maximum amount of shares or options that you're allowed to sell. What's the timeline with which you need to decide and do things? And then also, what's the deal structure? Is it compensatory or not? This usually has a large tax impact, so you want to make sure you understand it and know how it's going to work. Second, if you can participate, should you? Well, in our opinion, this really comes down to three different things. First and foremost, what are your financial goals? That should always be informing a lot of the different decisions that you make financially. The way that you invest, your tax strategy, the holistic how you approach your finances, your savings rate, and more. Second, what is the investment and concentration risk and exposure you have to the company? Is that appropriate? Is it inappropriate? How are you feeling about the company's business prospects and more? And then last, what are the tax implications? There are many times some things we can do to tax optimize, but not always. But you want to make sure that you're prioritizing your decision-making first with your financial goals, then on the investment concentration and risk side, and then last, trying to dial in the tax component a little bit when it makes sense to do so. So we know the key decisions to make. Now let's figure out how to decide what to do or whether or not you should participate if you can. There isn't a perfect flowchart, diagram, or decisioning framework that tells you, yes, I should participate or no, I shouldn't. Rather, different ways of approaching the problem, thinking about your personal situation, your holdings, the investment risk, the company, and more. So instead of trying to give you a follow A plus B equals C type of setup, we'll show you a couple of different frameworks and approaches, as well as market data, in order to help you think about how to come to a decision that's right for you. When individuals need to make key decisions in regards to liquidating or selling some or all of their equity compensation, we usually have a framework that we try to approach this with called a situation profile. It's not perfect, it's a tool, but we've kind of taken a lot of the different inputs and for a tender offer, bubbled it down into kind of three key variables. So let's walk through what they are. Number one, your company opinion. In order to want to hold your equity compensation and not take some chips off the table, you have to really strongly believe in your company. Not only that, you have to have the skills and experience to understand how your company is valued as an investment. And then once you understand that, also believe that the company is going to appreciate in value at a rate significantly above other alternative choices of how you can invest the cash such as in something like a diversified portfolio like the S&P 500. If you don't have confidence both in how you're evaluating the company as an investment and that it will continue to significantly appreciate in value, then you probably fall in that bucket of I should be selling, I should be diversifying. Otherwise, if you do, let's go to door number 2, your risk profile. Anytime you make an investment, individuals should be thinking about holistically, how does that investment fit in their overall investment plan and strategy? And when you build an investment portfolio, one of the ways that we think about is what's the level of investment risk you want to take? Generally, the more risk that you take, the higher the returns are going to be on average. But that conversely means that when you take a high risk portfolio, there's a growing and higher risk of loss. So since investing in startups are inherently a very high risk investment, you have to make sure and know that for your holistic profile and plan, or at least if not for this investment, that your risk profile accommodates and allows you to take the investment risk of holding this investment. If it doesn't, if you're a bit more conservative, which is totally and completely fine, you should probably be participating in selling as much as you can. If not, let's go to door number 3, your financial plan and needs. What are the key financial goals that you could or would like or want to accomplish if you did sell? Do you not have a big enough cash reserve or buffer? Are you thinking about taking a sabbatical, want to buy a new home, pay down that mortgage, pay off your student loans? There's a whole bunch of situations and reasons where additional cash in the bank account can be really healthy and beneficial for you. Investments are great. Almost every financial plan and portfolio includes an allocation to investments because all of us are eventually getting to a retirement age and thinking about how to build and grow that investment portfolio of ours. But you want to make sure that you're contemplating and thinking about what your goals are in the near and medium term, how the funds from a tender offer, if you did sell, could benefit that. Because many times that might say, even if I believe in the company, even if I'm high risk, there's a lot of other higher ranking needs right now in my life for this capital. And because of that, it's beneficial for me to take chips off the table. All right, tool and approach number 2, regret minimization. We use this a lot with individuals whenever they're making a key decision. And it's really simple, which is how do you frame this in a binary decision? If you had to do A or you had to do B, which one are you going to regret more? So in this situation, door number 1, how would you feel if you didn't participate and sell in the tender and then the price declines significantly in the future or additional liquidity opportunities never even materialize? Versus how would you feel if you did sell in the tender offer and from that point forward, the price increased significantly into the future at a rate well above things like the S&P 500 or a diversified portfolio that you could have allocated into otherwise? If you think about this, a lot of people tend to naturally skew in one direction or another. And that should help inform whether or not participating in a tender offer might be appropriate for you or not. Third, we never want to make decisions just based on an opinion. Whenever we can, we always want to incorporate data. And so here is the data that I think is relevant and appropriate for thinking about a tender offer. And the question is, do you believe your company is an outlier? No matter whether you're talking about a group of early stage companies, a group of late stage companies, or even post-IPO companies, the reality is when you look at a large pool of companies, the overall average returns of that group are significantly driven by a handful of outliers. And so over on the left bar of this video, the pre-IPO data, you can look at the stage of a company and what percentage of those companies on average ultimately end up exiting. Even at Series D and Series E, it tends to only be historically about 1 in 5 of those companies ends up having an exit. So do you think that your company is going to be in that bucket in the future beyond this tender offer, or is it not going to be? And let's say your company does eventually have an IPO in the future. Even when a company has an IPO, you can look at this data that's from NASDAQ over multiple years. And what it analyzes is how those companies performed relative to a diversified portfolio of companies in the Russell 2000 index. And what it shows, as you can see by some of the green lines, is that the top decile absolutely crushes it and kills it. The second decile, pretty good. The third decile is, modestly better than the Russell 3000. But below that, 70% of them ultimately underperform. And so this is something pretty critical to think about, is that at every stage of your company's growth profile, the ability to continue to grow, continue to outperform, the odds are on average against you. Your company needs to be an outlier in order to accomplish it. The last item worth noting here is, are you an early or earlier employee or relatively new to the company? All else equal, participating in a tender offer tends to make incrementally more sense if you're an early employee due to more of your options having vested, the exercise prices being lower, that likely meaning you have a higher level of investment concentration risk, and you probably end up having a higher need for liquidity. So this doesn't always apply, but if on average there was a skew one way or another, we always want to mention this too. Every company and every process is different, but usually the information shown on the screen here is what you're going to need to have or gather or specify in order to participate. Let's walk through them. How many shares or vested options are you going to be selling in the tender offer? When you do it, as long as you have multiple different grants or have exercised once or more times in the past, you're going to have what's known as different tax lots. You need to specify which of those you want to sell. And there's strategic reasons why you select one or the other for a bunch of different reasons, from short-term versus long-term capital gains. Is it an ISO qualifying or disqualifying disposition? Would these shares be eligible for QSBS or not? And more. You end up submitting all this information to the company, or sometimes via a platform such as Carta or NASDAQ Private Markets. There's typically paperwork that you have to complete, whether it's confirming or updating address information, tax forms, creating accounts, etc. And then if the company tells you anything else that you need to do, well, we got to do it. If you are participating in the tender offer, one of the key things you need to be focused on is choosing which tax lot or lots you want to choose to sell. And there's a lot of items I mentioned before that go into this. Is it RSAs, RSUs, ISOs, NSOs that you have? Have you exercised or not in the past before? The things that you're going to want to understand to make sure you know the tax implications and how to tackle these correctly is, first, how is the tender offer going to be taxed? Is this compensatory or not? Compensatory changes how the process works in a very material way. It's kind of counterintuitive to a lot of people. So you should definitely dig into this, know the answer, and if you don't understand it after doing some research, you should talk with a professional. Other things, do the shares that you have qualify for QSBS now, or would they in the future? Or would selling invalidate that QSBS capability? That's a really large tax benefit if they would, and you want to be able to think about that and use that to select the lots. If you're selling ISOs, have they met qualifying dispositions yet? Are you going to incur AMT? Is it going to be a transaction that's all done in the same year, so it's a disqualifying dispositions without AMT? And if you exercised NSOs, has that been done a year ago or not? Because it's going to be treated as either short-term or long-term capital gains. There's no easy, simple way for me to tell you you should choose A or B or C in this video. Rather, I simply detail all of the different things here that you want to be wrapping your head around in order to make sure that if you're participating and have multiple lots to choose from, you understand the pros and cons of each of these different ones. Or if not, then I recommend that you consult with an advisor who does, so they can help you figure out how to optimize. Somewhat related to that, when you select all of those different lots, the likely reality is it's going to create a taxable event for you. But understanding what the taxable event is and what other incremental tax strategies or tools you have to help minimize or offset or defer some of those different tax implications is also really important. I can't go through all of this in depth here, but just flagging it, you're likely to either generate ordinary income or capital gains, be that short-term or long-term when you sell. And if you do so, a lot of the things tax-wise that you probably want to be focused on are the impact of AMT from both how much might you pay on exercise dynamics, qualifying or disqualifying dispositions of the incentive stock option, and if you've paid AMT before, how you recoup some of that credit if applicable. If you're generating capital gains, is tax loss harvesting a possibility? Are you generating short-term or long-term capital gains? If you're generating income, are there different income tax strategies you can utilize, such as deductions or charitable contributions to reduce that? You always want to pay attention to state taxation depending on where you live. If there's certain shares that you're selling, such as from an ESPP or an ISO, you want to make sure you meet qualifying disposition requirements. And then last, QSBS. It's one of the most attractive tax dynamics if you qualify, but there's a lot of different things you want to make sure that you're thinking about or optimizing around in order to do it correctly. All right, last, let's understand your tender offer and tackle this from a few different directions, from what is a tender offer, what are some frequently asked questions, and what are some common pitfalls? All right, let's tackle the softball question. What is a tender offer? Well, it simply means that the company has set up a dynamic where you, as an employee or possibly ex-employee or investor, is able to sell some of your shares at a pre-specified price. And it matters to you because it's a situation where you can actually get access to liquidity, turning some of your equity in the company into cash prior to an IPO or acquisition occurring. The number of questions that we've tackled from clients for tender offers is far too long to list. But we've tried to bubble up here the top 8 or 10 or so questions that we've frequently heard, just to give a rapid fire Q&A format in case these were top of mind for you as well. Let's dive in. How is a tender offer price determined, and can you negotiate? No, you can't negotiate. Your company already worked with an investor or a group of investors in order to decide upon a price, and the decision that you're focused on is whether or not you want to sell some of your shares at that price or not. Next, how do I know if the tender offer price is fair? Well, this is a pretty individualized and subjective question. How do you know that a certain stock trading on the public markets is quote unquote fair? Different people looking at it are coming to different conclusions. The reality is you as an individual need to decide if you believe the price is fair, and relative to that price, do you want to participate or not? What happens if you don't participate? Well, in short, nothing. But what you do is you give up the opportunity to take some equity off the table at this point in time, and there's no guarantee that there will ever be a future tender offer, IPO, acquisition, or other liquidity event that you can take advantage of in the future. Are there risks to participating in the tender offer? Yes and no. Anytime you sell something, there is a theoretical risk attached to it. So if you sell some of your shares, there's the possibility that those shares increase materially in value. So from all the things that we talked about before, your financial plan, investment concentration risk, and tax optimization, you need to be thinking about all of those in regards to whether or not you want to participate or not. And again, in our experience, about 80% of individuals, usually the recommendation is to participate and sell the full amount, but sub 20% of those, maybe it's not the right choice for them. How will I be taxed and when? I think we've covered this before, but there's a lot of different ways that taxation occurs here. It could be ordinary income tax, it could be capital gains tax, short-term or long-term. AMT might come into play. Other different things like QSBS might come into play. It really just depends on your situation and the tax lots that you choose. Can I tender shares from different tax lots? Yes, you can in almost all situations. Can the terms of the tender offer change or be canceled prior to finalization? Yes, it can. It's not common. Usually once a tender offer is created and established, it tends to close within 30 to 60 days. So unless something material and significant happens in that time frame, I don't see changes occur too often, but it can happen. Will participating affect my future equity awards of options and RSUs? It's very unlikely that it will. Never say never, but it's very unlikely that it will. Do I need to consult a tax advisor before participating? I definitely highly recommend it because the taxation impacts here and the tax strategies involved in what you're choosing and why are pretty material and nuanced. So yes, I would recommend this. Can I participate if I have unvested shares? Pretty much no. Never say never again, but I haven't seen this occur unless you don't currently have vested shares when the deal is announced, but you will have vested shares when the deal is ready to be finalized. Common pitfalls to avoid. To sound like a broken record, every individual situation is different, but there are a handful of things that we've seen people mess up in the past, and we always just want to flag. So things to watch out for. Make sure you hit the deadlines and make sure you understand the tax implications because those have a lot of different items, whether it's qualifying or not qualifying for QSBS or even invalidating the possibility in the future, having your ISOs be qualifying or disqualifying dispositions, or if you're selling from RSAs or NSOs, is the sale going to be short-term versus long-term capital gains? Company sale dynamics. Is this going to be compensatory or not? The tax lots that you select to sell, what's going to be the impact? Have you selected the right ones and have a purpose and intent and design behind what you've selected? Make sure that you understand your personal financial goals. Don't ignore those. That should usually be the starting point from where you start all of your decisioning left of what am I trying to accomplish in order to think about whether or not you want to participate. And then last, not optimizing for the initial tax dynamics of this transaction and or the future tax dynamics of what future transactions might be if there's an additional liquidity event in the future. We hope you appreciated and found this equity comp playbook on tender offers useful. If you're curious or want to have more information about 3040 Wealth Partners, our website, our knowledge base, my email address, as well as my calendar link if you'd like to book a prospective client meeting and chat more, are all here on the screen. Cheers.